what is the 3-day cycle? All right, it dates back in the early 1940s, again, by the gentleman by the name of George Douglas Taylor. And it was simply a short-term way of trading, the markets. Now, I believe he traded, if I'm not mistaken, wheat and corn or soybeans back then in those days. And so, again, everything, he was in the pits. And what he would observe is certain groups of traders. Now, of course, back then, everything was physical in that you could see everyone. Today, we don't see anybody on each side of the screens. But you could see it. He could see everyone, and he could see those folks that he would designate as smart money or the big institutional folks, and he would, and then of course you'd have your locals, and so in the pits. And so what he would do is and he's a local, so what he would do is he would focus on those folks that had the big money. All right, what were they doing? What actions did they take in the early part of the session? Particularly in the latter part of the session, okay? What was the range of the day? What happened on that day? So he created a book, all right, and again, physical book where he logged in painstakingly all these observations, and really that's what they were. Initially, they were just observations. So he would the collective action of all these so-called smart money folks, all right, he identified that there were patterns that were repeatable. All right, and again, what we call these rhythmic patterns that go from extreme highs to extreme lows. And again, that's a repeatable pattern. Okay, and what he observed was these patterns not only repeated daily, but they repeated every 3 days. Okay, again, on average. All right, so the cycle itself is 3 days, as we, in its purest sense. But again, sometimes there's a flex day there.